Interest rates are going up all over the world, which means we need to change how we spend and save money. Rapid inflation has caused central banks around the world to raise rates. This includes the European Central Bank, the Bank of England in the UK, and the Federal Reserves in the US. The Federal Reserve plan to fight inflation by raising rates seems to have reached almost every part of the economy except one: American savings accounts. So why is the interest on your savings account not going up? Now drop a like and hold on to your seats as we will reveal how will this impact savers. Interest is the cost of borrowing money, and it is usually expressed as an interest rate per year. It is one of the main ways that central banks can try to stop prices from going up. Now let me tell you about the evolution of interest rates in 2022. In order to fight inflation, the world's biggest central banks are raising interest rates to a level that hasn't been seen since 2008. Central banks use interest rates as a way to control inflation, and all of the major economies have raised interest rates at least 2 to 4 times in 2022. Now, this is because inflation is at its highest level in decades. The war between Russia and Ukraine has caused food and fuel prices to go up, which has caused inflation to go up all over the world. Due to a lack of fertilizers and problems in the supply chain, food prices have gone up as well. At the same time, worries about war have caused crude oil prices to go up. Now, the sanctions put on the Russian economy have also caused energy, metal and coal prices to go through the roof. Europe is getting close to a recession because there isn't enough gas. Before the conflict, inflation was already going up because countries coming out of COVID lockdowns slowed down the global supply chain. As the prices of food and fuel went through the roof, central banks all over the world had to raise interest rates. The major central banks started raising interest rates back in March, and it looks like they will keep doing so until December of this year. Also, as the value of currencies has gone down, imports have gotten more expensive, which has made inflation go up even more. Businesses started charging more of their goods because input costs and interest rates were going up. This made inflation worse. The recent sanctions that the G7 countries put on the Russian economy have caused gas prices to go up as well. The group cut its prediction for global economic growth in 2023 from 2.8% in June to 2.2%. This means that global output will be about $2.8 trillion less in 2023. Now, to try to slow the rate at which prices are going up, raising rates make it more expensive to borrow money. It also makes loans more expensive, which can slow the growth of the economies, sending countries into recession. Now, the World Bank said that the slowdown in the world economy after a recession was the worst it had been since 1970. It said that the study found that the world's 3 largest economies, the US, China and the Euro area, have been slowing sharply. Also, a survey from World Economic Forum in Switzerland, which came out on Wednesday, found that 7 out of 10 of 22 top economies from the private and public sectors think a global recession is at least somewhat likely in 2023. The United States, which has the largest economy in the world, began to raise interest rates in March. Now, the US Fed raised rates 5 times in a row in 2022, bringing the federal funds rate to 3.25%. On September 21st, the US Federal Reserve raised interest rates by 3/4 of a point for the 3rd time in a row. This raised borrowing costs to their highest level since 2008 and showed that they will continue to rise well above where they are now. The US dollar index, which compares the dollar to 6 major currencies, hit the highest level it has been in 20 years. Reports from the news media say that long-term mortgage rates broke 7% this week, which is the highest they've been since 2002. In May, the annual rate of inflation in the US jumped to 8.6%, which is the highest level since December 1981. Now, let's look at what happens to the stock market, lending and borrowing, consumer spending and other parts of the economy when the Fed changes interest rates. When interest rates change, it changes the ways that people and businesses can get credit to buy things they need and plan their finance. It even affects some plans for life insurance. When interest rates go down, yields on bonds like US Treasuries and corporate bonds tend to go down, which makes them less appealing to new investors. Interest rates move in the opposite direction of bond prices. This means that even interest rates go down, bond prices go up. Also, when interest rates go up, the price of bonds goes down, which hurts investors in fixed income investments. As rates go up, people are also less likely to borrow money or pay off their debts because it costs more. When the Fed's rate go up, the prime rate goes up right away. The interest rate that banks charge their best borrowers is known as the prime rate. This rate is the one that other type of consumer credit are based on. If the prime rate goes up, banks will charge less credit-worth companies and consumers more to borrow money at fixed and variable rates. Now, using the prime rate as a guide, banks will look at the risk profile of other people to figure out how credit-worthy they are. Rates for credit cards and other loans will change because both require a lot of information about the risk of the person who wants to borrow money to buy something. The interest rates on short-term loans will be higher than those on long-term loans. When the prime rate goes up, the rates on money markets and certificates of deposits, the CDs, also go up. In theory, this should make more people and businesses safe because they can make more money from their savings. On the other hand, anyone who has a lot of debt might try to pay off their debts to make up for the higher variable rates that come with credit cards, home loans and other debt instruments. When interest rates go up, the US government has to pay more to borrow money, which drives up the national debt and budget deficits. Now, if rates went up by just 0.5 percentage point, the deficit would go up by 1 trillion. When interest rates go up, banks usually make more money because they can make more money on the money they lend out. But a rate hike hurts the profits of the rest of the world's business sector. This is because the cost of money needed to grow goes up. That could be bad news for a market that is already having trouble making money. Lowering interest rates should help many businesses make more money because it will be cheaper for them to get capital and make investments in their business. The Fed policies of zero interest rates has helped auto companies a lot, but rising benchmark rates will have a small effect. Now, in theory, lower interest rates on auto loans should make people more likely to buy cars. However, these big-ticket items might not be as important as borrowing on credit cards for more immediate needs. A sign of a rate hike can make people rush to close on a deal for a fixed loan rate on a new home. However, mortgage rates tend to move more in sync with the yield of domestic 10-year Treasury notes, which is largely affected by interest rates. Since this is the case, if interest rates go down, so will mortgage rates. When mortgage rates go down, it gets less expensive to buy a house. When the cost of borrowing money goes up, consumers tend to spend less. Now, when the number of people who want to buy goods and services goes down, businesses cut back on production and lay off workers. This makes unemployment go up. In general, when interest rates go up, the economy slows down. When interest rates go down, the opposite is true. When the economy isn't doing well, the central bank can cut rates. Now, the Federal Reserve wants to use this tool to respond to rising inflation or a recession by lowering the cost of borrowing money so that businesses and households can spend and invest more. The goal here is to keep the economy running smoothly. With that being said, thank you so much for watching. If you want us to feed you more informative videos like this, don't forget to drop a like and subscribe to the channel. See you in the next one.